Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, I'll speak about entries I find personally effective and efficient. Most traders are entering the market at unrealistic areas or less favorable trade entries. The entries I will talk about will be methodical and logical. Stay tuned. Leave the indicators alone. This will be a three-step process, starting with core curriculum, chart activity, and lesson plan. Let's jump right into our core curriculum. Retail trading ideology: trading breakouts, trading support or resistance retests, selling double tops, buying double bottoms, and trendline retests. On the left is a chart of a retail trader. We can see they got a few things going on: trend lines, channels, support and resistance zones, which I personally do not stand by. It does not have any sound logic and lacks true market metrics. Commercials trading ideology: selling after breaking highs, buying after breaking lows, entering and exiting around key levels, buying when cheap, selling when expensive. On the right is my chart of gold recently. My chart is clean and simple, free of nonsense indicators. I'm only concerned with real market metrics like the previous daily high or previous daily low, old highs, old lows, and speed. The commercials do not care about trend lines the common trader is drawing. Whenever I think about commercial speculators and small speculators, also known as retail traders, it always comes down to these two basic definitions. Commercials are buying and selling at the best price possible, and that is a known fact. Retail traders, however, are buying and selling at the worst price possible. I'm not going to tell you what side to follow, but I will tell you retail is nonsense. Starting with our chart activity, we're going to first mark out the areas of speed, equal highs, and equal lows. Second, we're going to study what occurs in a bullish trend or a bearish trend. Third, we're going to also think critically about what we observed in the price action. Let's take a look at some examples. Here, US dollar versus Canadian dollar, UCAD, and we can see that this market was most likely back and forth. However, there's definitely core principles that are following here. Let's mark out some key highs and key lows. So what I'm going to do is I'm going to locate some swing highs and swing lows during the sessions. So here, we have a swing high here. We have a swing high here. We have a swing high here. Then we're going to mark out some swing lows. We have a swing low. Who's lower here? We got to double check. Who's the lower one? This is the lower one. So this is actually lower. We have a swing low here. I'll make this blue. We have a swing low here. We also have a swing low here as well. So looking at the price action, we can see that most likely the market is turning around at these swing points. We can see whenever price broke a swing high, there was a high probability that it was going to sell. And as you can see, price comes up, breaks the Asian session high, which is also a swing high. Price then drops. Price then breaks a swing low formed in the Asian session, and even breaks the Asian session low as well here. Then it turns around and rallies up. Price then enters the New York session, rallies up, takes out a swing high, short-term swing high here, and also takes out the London session high. And then it turns around once again. Price comes down, takes out a New York session swing low, also takes out a London session low, swing low, and then price turns around. So we notice a few things are going on here. There's institutional sponsorship after breaking highs and after breaking lows. Like I said earlier in the video, commercials are most likely getting into the market for buying after they break a low and for selling after they break a high. You can see a direct relationship here. For example, we're looking at Bitcoin versus the US dollar, and as you can see, we have Sunday's range, February 26th, and then we also have Monday's range, February 27th. We can see that price comes up onto Monday and takes out Sunday's high. See that there. After breaking this high, we can see a quick displacement to the downside. Now, why is that? Because this is where they're liquidating buy orders, right? Or the buy side liquidity. Anybody that was selling has a stop loss probably above this high. So it would look something like this. So let's say they go short somewhere here. They found some short position here. Odds are there's a stop loss somewhere above this high or at this high. And what do? They run that high. They mitigate the buy side liquidity or the buy stop orders. and then price displaces to the downside. It's the same thing vice versa. So let's say price takes out the previous daily low. If we zoom out and we put this here, right? So now this is Monday and now this is Tuesday. Look what happens when price takes out Tuesday's low. Takes out Tuesday's low. We'll bring this over to Wednesday. Right there. We'll make this blue. What happens here? Price takes out the previous daily low and then runs higher. Looks like magic, but it's not magic. And it's not retail logic. They're just mitigating anybody that went long. So anybody that had a long position, let's say they happen to go long here, right? I don't know where they went long, but let's say someone went long here. Odds are they're most likely going to have a stop loss either at this low, right? And they're going to have a trailing stop. As they're making profit, they probably have a trailing stop. And what does the market do? It comes down and it squeezes them out their long positions. And it comes and takes out the previous daily low where most likely people have their sell stops residing, the sell side liquidity. So price comes down, takes out the sell stops, and then runs higher. You can see how it takes out Monday's low. And then we mark off Monday's high, right? Look at Monday's high up here. So mark this off as well. This is a Monday's high. And what happens when it takes off Monday's high? Look at how it drops lower. Is it magic? It's sound logic. There's a real measure and metrics behind it. There is something occurring above swing highs and swing lows. Retail traders are looking at this and they're thinking breakout. They're thinking price comes down, retest, go short. They think price comes up, retest, go long. That's not what occurs here. And most of the times the retail traders are getting it wrong. There are opportunities in the market where this does happen and it is permitted. But most of the time when retail traders are doing it, it's not permitted and it's not allowed. They're buying at expensive prices and they're selling at cheap prices. That's not how it goes. I thought it was buy low, sell high. And that's what the market makers do every single time. You can see that primarily in this example here every day. We'll bring it back. So we'll take this off so we can look at that together once more. Take this off. This is Sunday's range here. Monday comes up, takes out Sunday's high, takes it out, and then it drops. So now we have another daily range, high to low, right here. This high to this low. That's the range that price is trading into. Because we see price comes back into the range, consolidates, and now it's inside this candle. The next daily candle has either two options. It's either going to stay inside this candle's range, or it's going to break one side and then run another direction. We can see it breaks this side. It breaks the low range. It's buying low. It buys low. And then it runs higher, back up. And what does it do in that process? It runs up and takes out Monday's high. Wednesday takes out Monday's high. You can even see it here. So let's say we're looking at Tuesday. Let's say this is the high for Tuesday. Wednesday takes out the previous daily high. And Wednesday also takes out two previous daily highs ago. So it takes out Tuesday and Monday's high. And what happens? Price runs lower. And look at that sell-off. That's where we had the dump on Bitcoin. All the bag holders, all the buyers that thought crypto was going to make another leg higher. They're in drawdown now. And price runs all the way down. That's how you're able to catch these big moves. This is how you're able to see where the market makers are most likely going to make turning points. Now, when it comes to specifically looking for entries, that's a different case scenario. You may be looking for something like a break retest. I'm not looking for that personally because I know that's not what the commercials are doing. I know they're waiting for a certain pattern or they're going to leave a footprint in price action to allow themselves to get in again and then carry price in their intended direction. We can see that here. Look at this large footprint that they leave. They leave it right there showing you that they're most likely going to sell. Now why? Because of the shift occurring here. Look at the speed Now, I would call this in basic terms speed, but most people would say, oh, that's a fair value gap. Yes, you're definitely right. But it's showing you signs of speed to the downside. Speed down. So when price returns into it, odds are you might gonna see distribution come in here. And as you can see, price runs up into it. Does go beyond it a little more, right? Happens. It's not completely retail logic, support and resistance. We know that it's going to cut through candles. It's going to cut through zones. But this is a metric, a measured area. I'm not randomly drawing a box here saying that's true resistance. Price should not break out of it. And if it gets above it, oh, it's a break retest. No, I'm not thinking about this zone like that. That's what retail is thinking. I'm not thinking that. I'm thinking completely opposite. I'm thinking, okay, speed down. Okay, consolidate. Okay, we got close to it, comes down, runs back into it. There's a selling opportunity occurring. And we can see it could either form most likely inside the speed area, but we can see they run the buy side liquidity above the previous daily highs. Takes out Tuesday's high right here, and then it takes out Monday's high, and then it runs lower. That's exactly what's occurring here in this example. Versus the US dollar, and we're looking at last week's range broken down on the hourly. So we can see we have the previous daily high here on Monday, and this is Tuesday. Look at how Tuesday comes up, takes out the previous daily high, and runs lower. Runs lower. And ever since breaking this high, it keeps distributing all the way down to Thursday. Now on the other side, on the opposite end, we can see price takes out a previous daily low and happens to trend back up. Commercials buying cheap once again. Commercials selling at expensive prices once again. It is sound logic in the market. Same thing for stocks, same thing for commodities, same thing for gold, US oil, cryptos, etc. They're doing the same thing time and time again. They're not going to leave this sound logic. It's not indicator nonsense. There's principles that it has to follow. They're selling expensive after breaking a previous daily high. Everybody thought probably British pound on Tuesday breaking this previous daily high and it coming down into the high probably, or some support zone that they drew, that it was going to go higher. That's what they thought that was going to occur here. They thought it was going to go up, come down, support, and then bounce higher, or retest, go higher, right? Because this was resistance. The previous daily high was probably acting like some resistance zone. It broke through it, retest, go higher. Absolutely not. Doesn't happen here. Price comes down and continues to distribute all the way through Thursday. We can even see here, look at where there's a small pocket of speed occurring here. Where's the first area of speed here via 1 hour that occurs after breaking this previous daily high? Right there. There's the fair value gap. 1, 2. There's even one lower than it. But let's say the first initial one that forms after breaking the previous daily high. That's what we're looking at. Look at how price comes back into it once more. Price trades right back into it, and then it runs lower. You can see here, look at the previous daily low broken here at a cheap point. Now, if you've been following me for a while, you know anything below SOP and midnight opening price, it's going to be a discount, high probability buy. So there's a lot of confluences going on here. Price breaks the previous daily low, comes below Sunday's opening price. During London close, there's some type of reversal, makes the low of the week on Thursday. After breaking this low, where's the first sign of a fair value gap or speed? Right there, here to here. Look at that fair value gap. Price trades down into it, and what happens? It continues to trend higher. When it comes to my entries, I am mainly concerned with the following. First, I'm either going to buy or sell after a break of a higher low. Like I showed previously with Bitcoin, UCAD, or GU, when price breaks a previous daily high, I can immediately sell right there and then. When price breaks a previous daily low, I can immediately buy right there and then. Next, I would normally wait for a break and scale down to a lower time frame to find if a fair value gap has formed. That's normally going to be my fingerprint or footprint that I'm looking for in the algorithm to give me greater signs that the market is most likely going to head in that direction. Third, I can wait for a break and find an optimal trade entry. Last, I can either buy or sell above or below midnight opening price. Let's take a look at some of these examples. We can see for GU, Monday comes down and takes out Friday's low. Right, so we go all through the weekend, Sunday comes around, and then Monday opens up and takes out Friday's low. We can see instantly there's a turning point here. Like I said before, the commercials are most likely buying after they mitigate previous daily lows. or short-term lows. This is the 15-minute time frame, and as you can see, there's a fair value gap here, right? There's two of them. There's one here and one here. I'm most likely going to opt for the first one because it's a lower price. I'm going to be buying at a cheaper price, not a higher price. But you can see here how it does. Let me just draw this out so you guys can see it. Does tap into that. If you look at it in other form, optimal trade entry, high to low, change the fib. We go from here to here. And what happens? We'll take off this indicator. Price comes down below 50%, trades right down into what? 62% retracement level. Hits it. Ever since then, it keeps running, hitting all the projected fib ranges that it should potentially reach for. Let's say this is first scaling, TP1, TP2, TP3, TP4, essentially, right? Or extension 4. And this is extension 1. And this is your first part where it comes down, and this is where you're taking off a portion of the trade here, another portion, until you're finally out the trade. Or even if it's a micro lot, you get in, you scale out, and you collapse the trade. That was a winning trade. Or you continue holding for TP1 or TP2 for your initial target. But looking at that, look at how it breaks the low. Let's see what happens, specifically what happens when price breaks this low on the lower time frame. Let's see on the 1 minute time frame. And we'll play it forward so we can see what's going on. We can see there's a fair value gap here on the 1 minute on the lower time frame. There's one here. Like I said, there may be two that forms. There may be three. I'm normally going to opt for the first one that forms after the break. That's what I like to personally see. 1 and 2. Now, even on that break, we can scale up and see where's the highest point it has been. I don't know if the price is going to continue dropping down, because if it runs a little higher, that means I have to adjust my fib again until it comes down below 50%. Then I start seeking for buy setups again. So we'll play it forward and we'll see what occurs. I'm going to speed it up for video's sake. And we can see it gets really close. Doesn't hit the first initial spot where I would want to get into the market long. Sometimes you're going to miss your entry, depending on your filter and depending on your model. So according to Deontay's model, I would have missed that. But you can see where the gears are turning, where I'm saying, okay, boom, now we got some action. Now we should be seeing some excitement to the marketplace going to the opposite direction. We just took out what? Sell side liquidity. Because if we zoom out, put this back on the 15 minute, what's below the previous daily low? That's sell side liquidity. And if you were to look up, this is the previous daily high, all the way up here. I'm gonna mark it up properly for you guys. Here to here. And I'm gonna show a lower time frame model idea surrounding this, because I know people are saying, but this is only surrounding the previous daily highs and previous daily lows. It's easier to understand the concepts on a higher time frame basis. And you can see that's the previous daily high. Now, if it took out the previous daily low, odds are it's going to probably run to the buy side liquidity above the previous daily high. So we'll play it forward. We'll 10x it to see what happens. And you can see, look, sell side to buy side. Exactly what I said before. If anybody was going short here, they found some type of short position here. They have a what? Protective buy stop here. Anybody that was going long, let's go long position. Anybody that was going long from this low point here, right? They have a protective sell stop below this low. And you can see it gets mitigated, and then it runs up and it mitigates both sides of the market. Sell side to buy side. That's all this market is doing. The primary drivers to this market is interest rates, right? When the central banks are increasing their rates or decreasing their rates, and the buy side and sell side liquidity surrounding the equal highs, the equal lows, the swing highs and swing lows. Clear as day. That's what you're using to formulate your entries. You're not getting into this market randomly, break, retest, nonsense. Nonsense. Now let's look at something on the lower time frame. Common model that I like to use, which is the Asian session model. I am taking a previous session and acting as if it's a previous daily high or previous daily low. So let's say this is the previous daily high and this is the previous daily low. As you can see with the hindsight, without me rewinding it using the tool, we can see it takes out the buy side and then it runs to the sell side. So it took out the let's say technically this was the previous daily high. It took out the previous daily high and then it ran down to the previous daily low, right? Let's active. This is one whole daily candle and this is another daily candle that potentially is forming. Takes out the buy side and runs to the sell side. But let's see what's happening on the lower time frame when this is occurring. So let's scale back exactly to when it breaks. Now this time period right here is going to be 12 p.m. to 8 p.m. for anybody that's wondering. That's the New York lunch session. It's normally a dead zone, not trading here. But I'm using it for buy side and sell side logic. Price comes up, it takes out buy side logic. I'm then going to scale down to the lower time frame to see what's going on. I preferably like to scale down to the 1 minute time frame. And as you can see here, going into 8 p.m. after taking out the buy side, we have a fair value gap that forms here. The fingerprint right there. And as you can see, price trades right into it. Back onto the 15-minute time frame, we can see where's there a most recent swing low. If we were going to go short there, where's your most recent 15-minute swing low? It's right here. 1, 2, 3. That's a swing low. That's a swing low. So we have one here, and we also have one here. And then we have the actual lowest one of that session as well that hasn't been mitigated. So these are targets or projections to the downside if you're going to sell. Because it took buy side, it now should be reaching for sell side, a counterparty, right? Go back down on the 1 minute time frame. Hypothetically speaking, we're going short exactly in that fair value gap, and stop loss is going to be above the candle that starts the fair value gap or the most recent swing high. Let's say we're going with the swing high. And then we're aiming down for the sell side liquidity. So somewhere down here. And we'll take profits on the way down. So we'll play it forward, because I know this is going to be too fast. And as you can see, we get the entry. We'll take this off. Multiple times it hits into that fingerprint. And what are we still drawing towards? We're still drawing towards this sell side liquidity down here. I'm going to speed it up. Sell side liquidity taken. Now when this sell side liquidity is taken, I'm looking for any reaction of the market showing signs that it wants to turn around, showing another fingerprint like this, some type of speed to the upside now instead of speed to the downside, because we broke the low. If the commercials are looking to buy below this low, they are going to give some type of fingerprint or show some action to want to run higher quickly. And let's see if we get anything like that. We don't. No fair value gap to the upside after breaking that. We run even lower to this low. After breaking this low, is there any fingerprint that's going to be shown that the market wants to go higher? Potentially there is. As you can see, after taking that low, look at the speed. Fair value gap. There's one here. Right after taking that. That could have been your sign after taking out the previous, and I'm saying previous, like a previous daily low. It's the same thing. It's fractal. The same ideology is fractal. Taking out a swing low, there's a sign that it probably wants to go higher. That's the sign there. And where would you be aiming for it again? You're now aiming for probably buy side liquidity. All these equal highs. This is buy side liquidity. All these swing highs that haven't been broken yet now could be a potential reach for the algorithm to the upside. So if price comes down into it, you can go long there. Here comes another fingerprint as well. It's even larger and more significant. Look at how price trades right into that. Price trades down into it and then what? Rallies. Now let's say hypothetically you're going long. Here, stop loss below the most recent swing low or the candle that starts the fair value gap. So that could be the swing low there. Then you're aiming for some type of swing high that hasn't been broken. Any of these here, where the market makes that turning point here, here, here. But let's say we're just going to draw it to this one just for reference sake. We'll move this over. And you have another one here. Let's say you're going to pyramid this. Price trades down into that. Stop loss below the most recent swing low or the candle that starts the fair value gap. And you're going to pyramid that up there. And we're going to make this smaller so we can see it as well. So it's two separate trades. And we play that forward. And we're looking for some type of market reach or draw to the upside. And that's how you would play that forward. And we'll speed it up for the video's sake. And as you can see, we finally get up there. But then when we finally play it all the way through, and we can even mark off the high it makes in the session as well, because this is an unmitigated high. We'll play it all the way through so now that we can watch it. And all this whole time, you can see it just took up this. Is there signs for it wanting to go lower? Is there a fair value gap to the downside? You can see one there. We'll pause it. There's one here. Let's say you want to go short here. You take the short there. That doesn't necessarily mean it's going to be a winning trade. You place your stop loss there, say above the high, and you look for a short back down to sell side liquidity. All these equal lows here now. Let's say you're aiming for that. You get stopped. It happens. But you had the right idea though. You had the right idea. Just may have not been ready for the algorithm to turn over and finally go. Right? As orders weren't fully booked yet to finally reach down to sell side liquidity. But you can see our price trades up, back up to that same high that it broke previously on the 15-minute time frame. Look at how the price trades back up into it. Put on the session indicator. Trades back up into the New York lunch high. Right again. Creates equal highs and then finally drops down. Back on a 1-minute time frame. And what is it ultimately probably drawing down to? Maybe that sell side liquidity that hasn't been taken here. From this short here, this short position here. And you press play. Many times the market's giving speed, showing you speed, and wants to go lower after taking the high. And look what it does. Finally takes out that high. And after taking that high, does that mean you go in looking for a buy setup? Potentially. That's all up to you. I'm not telling you what to do specifically, but I'm telling you when the most optimal trade entries are coming in. It's after mitigating highs or lows. That's always sound logic. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoy this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high quality Forex videos. As always, safe trading, leave the indicators alone, and peace.